Trump sending out his new tariff threats. The Fed just dropped their latest signal, and the one big beautiful bill is about to unleash government spending. Then at the same time, stocks and bonds don't agree with where we're going. They're telling two different stories, and somebody's got to get it wrong. Let's break it all down and see what's going on. So right now, Trump has really been expressing his displeasure with how the progress has going regarding tariffs and their negotiation tactics, because countries aren't coming to the table with deals that are good enough for the United States. And so far, that's been a big L for the president, but he's still riding high right now. He did broker the ceasefire for the Middle East that seems to have held up so far. Also, his one big beautiful bill got signed into law. Trump has been sending out letters, though, stating tariff rates for the receiver, and said at the cabinet meeting that a letter means a deal. So maybe that's how they'll get their 90 deals in 90 days. But that's not what he was saying a month ago. A month ago, it was completely different. But now they get a deal, a letter, and negotiations can still go. So today he started off the day stating that a minimum of 7 countries will get their letters sent to them. More got that. I believe it was closer to 8. And just to highlight, there were 22 countries, all ranging from 20% to 40%, and Brazil being the highest at 50%. So you could go on here. Trump releases 8 more tariff letters. Here's how new rates compared to Liberation Day levels by Victor R. You could go check in on the list of countries that got tariffs and what that current tariff rate is. And just to highlight, August 1st being the max and final deadline to get things moving on, or the White House may set the rates back to the April 2nd Liberation Day tariffs. So we'll keep on watching this. But speaking of deadlines, with the tax and spending bill passing and being signed into law, spending is about to be spent like it hasn't been spent. And those bills need to be paid, and especially the interest expense that comes with that. And interest rates are kind of high. They've been high for a while, much higher than Trump would like. So let's go look at what Trump's talking about these days. And if you go to his Truth Social, he starts off, anybody but too late. I bet this goes to the, maybe to comment on the shadow Fed, and everybody's wondering who's this new Fed pick he's gonna pick, and maybe like hey, it ain't gonna be Jerome Powell. That's it. That's all I'm gonna give y'all. But let's look at some more shenanigans. So our Fed rate is at least 3 points too high. Too late is costing the U.S. $360 billion a point per year in refinancing costs. No inflation, companies pouring into America, the hottest country in the world, lower the rate. So yeah, he's taking a direct stab at the Fed right now for not lowering rates, and it all goes back to what he's been talking about, like, hey, we got this big beautiful bill passed, we're about to be spend, and like rates are kind of high, these bills are kind of high, like lower them a little bit. But there's this article right here on Market Watch, and what it's talking about is why Trump might not get rapid interest rate cuts even after he replaces Fed Chief Powell, by Jerry Bartosh. Jerry B. And it goes into these reasons. The first being that the Fed chair only has 1 vote. A new chair would only have 1 vote of the 12 votes on the Fed board, and that he would have to, or she would have to, persuade the 11 members of the FOMC to go along with him. The Fed guards its independence, so with Trump really pressuring the Fed to cut rates, that's more politically structured in that, and that's not what the Fed wants. They want to be known as independent from the government, and when the president's telling them what to do, and if they fold, that's real questionable on the Fed's part and their credibility and the place they hold in the global economy, so they really don't want to do that. So they're going to keep guarding their independence. The board makeover won't be quick, so each of the 7 members is appointed to a staggered 14-year term to prevent any president from gaining excessive influence. Only one of the members, Adriana Kugler, has an expiring term in the remainder of Trump's presidency. The other 3 Democratic appointees could stay in place until the 2030s. Powell can stay on the board if he wants. He has 3 years left on his 14-year term as a Fed governor. Then the next one is they don't directly control rates. The Fed influences borrowing costs indirectly using an obscure short-term rate. It's usually like overnight rates, only used by banks to ensure a smooth running financial system. But what does control these long-term rates if the Fed doesn't? Well, the biggest influence on long-term rates is inflation. If investors think inflation is getting worse, they will demand higher, longer-term rates to compensate them for the risk, even if the Fed lowers short-term borrowing costs. If a new Fed chair cuts rates at Trump's word, pretty much, investors might view such a policy as inflationary and demand higher rates. So it's almost like a stab in the foot, and all of this comes this is probably why Trump was on Truth Social talking about the Fed anyways, because today's spotlight was the Federal Reserve's FOMC minutes for June. So that's from their June meeting, and there were two popular bets that would happen. Either camp one would be the Fed decides, hey, we don't really want to cut rates this year, like we're fine just staying steady due to Trump and his tariffs, or the other popular vote or camp would be cuts of maybe 2 or 3 later this year. Now, let's look at exactly what we got. So you could pull this up, just you could go to Google, type FOMC minutes June meeting 2025, and you could find the website, go through this 18-page PDF. We're not going to do all of that. I'm just going to give you the highlights. So overall, the Fed officials see that the rates can be lowered later on this year, assuming either tariffs aren't as bad or even their impacts aren't as bad on the economy, or a weakening economy. So either tariffs aren't as bad and inflation's not bad due to these tariffs, or allowing them to cut, or a weakening economy that needs stimulated through lowering rates. So that's kind of what they said. Their fears of recession are slowly going away, and the fear of stagflation is still there, but it's to a way lesser degree. But remember, this is back in June. This week was really big regarding tariffs, and it's almost like all of that's just kind of reigniting itself. They are noting that lower income households are buying cheaper alternatives, which is a sign of increasing financial strain that can be even further impacted by tariffs, especially if we see these Liberation Day rates again, maybe. They also point out that they're still thinking inflation is more of a concern than a weakening labor market. So they think that risks of inflation being sticky due to tariffs is more of a problem. The dot plot showed that 10 FOMC Federal Open Market Committee members projected 2 cuts, while 9 predicted fewer, so more expect at least 2 cuts. Even as they cut rates, officials think we aren't far from the neutral rate, which doesn't spur nor slow growth. So that's some interesting news we got to the Fed. They think that even if they start cutting rates, like, hey, we're not too far from where we're going to decide to stop cutting rates. And then maybe like we're in a completely different cycle to where now like it's not in the forward mirror, in the forward looking right now how we're expecting them to continue cutting rates. At the neutral rate level, it's like, all right, well, maybe we need to start thinking of raising rates in the near future again. Not to that extent, but that's just kind of the way to describe it. And with all of the moving pieces today, the tariff news, the Fed minutes, those were the main two. And then with the Treasury auction, which I bet that one played a smaller extent in the moves of the market today. It seemed like the market opened up, and this is the S&P 500, it opened up pretty optimistic, like, ooh, we got the Fed minutes today. I bet they're probably going to talk about cutting rates. We're kind of excited about it. Let's go pile in stocks. And then like there's the sell-off, and then as more news developed throughout the day, stocks went back up. But what about Treasuries? Treasuries, I mean, overall, I remember looking at this chart earlier. They've really been range bound over the last few months, and the auction showed good demand, so that's when we've seen Treasuries really start calming back down. But I mean, they're still range bound, like they're not moving too much. Now, To talk about that diversion between what stocks and bonds think, there's this divergence between the two, which send conflicting signals about the economy. Overall, stocks, as we've been talking about for a while, seem to be feeling very good about how things are going, while bonds haven't been feeling so good about where the economy is headed. Riskier plays have all been pouring into traders' picks as the trend has been really up. Market forecasts have been bright, hinting at higher returns and higher economic growth, and maybe even if all of this continues, it could seep into earnings, then higher beats on earnings. So people expect earnings to come in. If higher returns and higher economic growth keep on showing up in the data, maybe these companies beat expected earnings, and that would justify valuations, and then higher stocks, higher highs, possibly. But on the other hand, if you look back at these bonds, let's go and look at SOFR futures, a secured overnight financing rate. What these show is that the bond market's expectations for what the 1 year overnight rate will be has dropped, and their rate is closely tied to the federal funds rate, suggesting that the economy may need a boost due to slowing. So that's not looking good. But what is looking good is that Treasury auction. Despite us getting that weaker auction yesterday for the shorter term, I believe that was the 3-year notes, the Treasury yields have been taking a breather after the $39 billion auction for the 10-year Treasury notes came in pretty strong as demand, as people scooped up this rate of 4.369% on the 10-year note. So people are feeling pretty good about buying debt, and that yield that we just mentioned, that 4.362%, was lower than expected. So demand's still pretty strong for these 10-year notes. The 10-year Treasury yield affects mortgage rates for the 30-year mortgage rate. It's kind of counterintuitive because there is a 30-year Treasury, but it follows the 10-year Treasury because usually people pay off their home, sell their home, or refinance their home within like a 7-year period. So lenders typically equate mortgage rates to this 10-year Treasury yield. So the strong demand's kind of that's good news, because what people's really been focusing on is, hey, like, are these tariffs going to put a sour taste in all the foreign countries that buy these treasuries and lend the government money? Will that like impact their willingness to buy these treasuries? And then how about like households and bidders? Will they be buying these treasuries, or are they looking at stocks? So overall stocks, let's go back to stocks and pull up a couple charts that I want y'all to look at. So right now, Nvidia made some spotlights today. Nvidia. So what Nvidia did today, and I mean, it's just up 1.8% and then another 24 basis points after hours. This one is up, and it kind of fell a little bit, and this is after it hit 4 trillion. A $4 trillion market cap. I think it said it was the first company to do that. It's the most valuable company in the world. And then a new all-time high hit for Bitcoin. It hit 112,000 briefly. It's slightly under that right now. You know, people like taking profits when we hit these highs. But, I mean, both of these are at all-time highs, or right about. And then the entire market overall, like, everything seems pretty rosy and daisy. What about the VIX? What the VIX looking like? While all my slow charts load. So yeah, the broader market seems pretty pleased with how things are going. It's quite the roller coaster. The VIX is under 16. Wow. Keeps on bouncing off of this 50-day moving average to the bottom end of it. So that's interesting. So despite corporate earnings growth concerns, and despite the Fed forecasting slower growth for GDP and the pile of growing national debt, that problem, it's all still going up, and a lot of people wonder whether or not that is sustainable. Then look at this. Not to mention that this article right here, warehouse vacancies climbed to the highest level in more than a decade, by Liz Young. And what this one really goes into is that The vacancy rate ticked up to 7.1% in the second quarter of this year out in the U.S. That's the highest it's been in 11 years. The first time it's surpassed 7% since 2014. The amount of the U.S. warehouse space listed for sublease reached a record high of more than 225 million square feet in the second quarter, up 25% from the same period a year earlier. Developers pulled back on new construction due to weakening demand. But still, the total amount of warehouse inventory across the U.S. was up 19% in the first half of the year compared with 2019, while new leasing activity was down 5% from 6 years earlier, according to Cushman report. So, and rents continue to rise. They did mention in this report that more people are touring warehouse space. But remember, this is the second quarter, and that's before a lot of this mess happened and then unhappened, and now it's rehappening. I bet a lot of people are going to be like, well, you know, like imagine like the property manager calling up, like, hey, what do you think about that spot? Do you want to lease it? And then the people that was touring at these companies, they're like, nah, I don't really want to do it. And then look at this one. Tight diesel supplies threaten to raise transport and heating costs by Anthony Harrop. So we're not going to get deep into this, but diesel fuel shortage looms, threatening higher transport and heating costs next winter. Watch that. Low diesel stocks are due to refinery run cuts in the late 2024, sanctions on Russian oil and OPEC output, cuts removed heavy crude, impacting diesel production. And diesel plays into so many different industries: freight transport, agricultural equipment, industrial activity, heating. Why didn't I highlight that? Around 4% of U.S. households use heating oil, a distillate fuel oil like diesel, to heat homes. So if oil prices go up, that's another inflationary cause. It kind of goes in line with kind of what the Fed was saying. So we'll keep on watching that, and whether or not that takes a toll on the economy or not, and where that leads the Fed to go, because they said a weakening economy isn't necessarily on their books. It's inflation being the concern. So while stocks cheer Nvidia and Bitcoin, bonds flashing warning signs, spending about to surge, debt piling up, and the Fed walking on this real tightrope. It's real hot. Like they're in a rock and a tough space right now. Where do you see all of this heading? Because I have no idea at all. I just invite you back to join me, and we continue learning and unpacking it all together each and every day here on this channel. So let me know what y'all think. Subscribe if any of this is valuable to you. I'm trying to stay consistent for y'all, so hopefully somebody out there is watching these videos. I like coming on here and sharing with y'all and talking to y'all, seeing what's going on. But let me know what y'all think. Thank you for being here. Thank you for watching. Thank you for hanging out with me. Hope your day's great, and I'll see you next time.